Well, one of the things I try to do, Kelly, and with this, especially when things go off the rails, which they have occasionally over the past month, is you have to just look at facts on the ground. You know, what do we absolutely know and what is not contestable? So we do know that China's, sentiment, since the newspapers are state-owned, we're never going to get a real clear image of what the Chinese are thinking. That's number one. And number two, to really calm my fears, I think about the trade imbalance, right? China sells us $500 billion worth of goods. We sell them $130 billion back. So no way is China, in the long game, they're just not going to give this up. And I think there will be a resolution. But it's awfully hard to stick to that big theme when you're having these, tweets that are coming every day, and things do seem to go off the rails more frequently than we would like. So the bottom line with all this is, if you have a year horizon of investing, I would not be in equities, I would be in cash. But if you have longer than a year, I would say buy the equities that you like, stick to your plan, and you know things will get resolved eventually.
Michael, it sounds like you're fairly cautious as well, given where we are in this bull market cycle, given the signals we're seeing around the world.
Yeah, I think that's right. I mean, probably no surprise, just echoing some of the comments from earlier, but given how far into the cycle we are and given the volatility and uncertainty, we are cautious. Like everybody, we're focused on the trade wars, and we hope that what we hear today is actually a real step in the right direction. But I think we've seen this a lot, so I think it's way too early to get overly excited and really pile in.
You have some interesting ways to maybe play this. Alternative asset managers like Blackstone, some of the pipeline names, Kinder Morgan and Bridge. I mean, talk a little bit about those areas of the market.
Yeah, so those are a couple areas that not specific just to what's going on with the trade wars, but just more generally are areas we're finding attractive. And there's a couple of things that's interesting. You don't normally think about alternative asset managers and pipeline companies in the same breath, but there's actually some similarities, although obviously meaningful differences. So similarities would be in a world where it's really hard to find income. These stocks offer very nice upfront yields, so sort of 5, 6, 7% current coupons, and they have dividend growth. And they have dividend growth because both of them are in secular growth industries. The alternative asset managers are raising money hand over fist. The fees are very attractive, and this low rate environment just further reinforces that attribute. And then on the pipeline side, it's different, but the secular growth story there is shale. So we all know that the growth in U.S. shale is having a negative effect on oil and gas prices, right. But the volumes are growing tremendously. And these pipeline companies are very well positioned to benefit from that. They fixed their balance sheets, the issues they had years ago, and with 5, 6, 7% yields and growth, we think they're very attractive. Oh, and one last thing. Both of them are converting from K1s to corporations, and that's an important dynamic because it's really increasing the size of the investor base. There were a lot of people and a lot of organizations that couldn't invest in them before, and now they can. So we see that as a positive catalyst.
Peter, you like computer security and cloud storage. This is an area of the markets that have higher multiples, and we've seen in recent days, it's in the software sector, if we broaden this out a little bit from Autodesk as well as Box, that they are impacted by the tariffs, that they are impacted by the trade war because of uncertainty. And because these are higher multiple stocks, the drops that we've seen in these stocks have been greater. Is that a concern of yours?
Not at all, because here's what I'm doing. When things get very crazy the way they have been, it's very hard to look at specific, trade details every day. And instead what I do is I look for themes. So if you just step back and say to yourself, in years from now, will computer security be around? And I think the resounding answer is yes. It is a war of cybersecurity that is an arms race. It will never go away. And if you poll any chief risk officer in any large company, and you were to ask them, can you certify today that you spent all the funding you need to be immune from any attacks, they will always say, no, we need more funding. So that's the first thing. And then in terms of data storage, same situation, right? There's nothing that's going to replace that. And as you know, with every day that passes, we just get more and more demand for data storage. And so that will go on too. And until we have something that's really breaking, say something like quantum computing, which is far, far away in the future, these companies still will be an anchor in your portfolio, especially when you have times like this, when you sometimes don't have a compass, frankly, and get a sense of what's going to happen next week, but you know further on that these themes will be robust.